Hey everybody, welcome to the Thursday Financial Thing Investing live stream where we talk about everything good about investing and bad about investing, peer-to-peer lending, general stuff, inflation, banking, stocks, whatever comes up, whatever's interesting. We're going to talk about it. Today also, hopefully everything should be good with the stream. Thank you for joining. We were supposed to today, this evening, have Roy Warren, director from P2P lending company Folk to Folk, and Gary, who's the, I want to say COO or CCO. I can't remember which, but important people over there at Folk to Folk. But unfortunately, Mr. Warren had an abscess in his tooth. He had to go get some emergency dental work done. So I said, he still wanted to do the stream. And I said, look, the way that your tooth is feeling, you're probably not going to be up for chatting. So let's go ahead and postpone it until April, till, schedules work out. He's feeling better. So today will just be a regular stream, and Roy and Gary will be here. Hopefully, all being well, the P2P gods will allow it. So on April 27th, 2023. God, can you believe we're in 2023? So this is the new schedule. Did I get that right? Sorry, I said did I say folk to folk? Yeah, this is not right. This is incorrect. Let me pull up the correct graphic. Of course, we always have to start the stream with a mess up. That's the way it works. I don't have the graphic on hand, but anyway, it's March the 30th. We're going to have planned. Robert will be here. April 13th, Capital Stackers with Steve, director of Capital Stackers. Then April 27th will be Folk to Folk. And then also lining up some really, really good, interesting guests for you for the upcoming months. We're definitely going to have more interviews, more Q&As, more live sessions. Hoping to get Lonepad, possibly some other companies that I got in the works. Trying to get Easy Money on here. CEO of Easy Money, I've reached out to him. We've had some communication, so hopefully he will be coming on soon. I would say probably in April or May. Hopefully, fingers crossed. So good stuff. Anyway, apologies about today, but things happen. If you can hit that thumbs up, I appreciate it. Subscribe to the channel if you're not already subscribed. Quick hi to everybody in the chat. Paul from Kenilworth. Annabelle is here from a rainy Sherborne. Why would you go to Dorset at this time of year? Annabelle, you could have been in Spain. Colin Perry is here in the Peak District. J.M. Roberts in Toronto. Peter Clark, first time in months. Greeting from Buckton and Huntington. Where have you been, Peter Clark? We missed you. Welcome back. Peter Vince, of course, in Leatherhead. Dave Dawson from Staffordshire. Mike Powell in Wet and Windy, wherever you are, probably in the pub. Alan Stratford's here. And Stephen Hale from Nottingham. So thanks to everybody for spending your time, spending this Thursday evening. Let's get right into it. I thought we would do a quick Lonepad update because it's been a while since I've kind of checked out what's going on at Lonepad. Things just always really slow and steady. Rates have been going up with Lonepad. We have a total amount of Lonepad loans now just creeping up to that £77 million mark, with a loan to value of still a very low 42%. Total loan value $152.3 million and total security value $182.5 million. We have now 12 lending partners, and that's definitely gone up a couple since over the last 6 months. I believe it was at 10. Now we're at 12. Interest coverage size £42,322 and 12p, and 0 loans. This is important in the ICF, which means everything seems to be going along swimmingly over there. This 1 day estimated time to invest, less than a day. Estimated time to liquidate right now, if you need to grab some water, less than 1 day. And I mean, look at this down here at the bottom. These are big numbers. Total number of loans since inception on Lonepad, 425. This is not a small amount of loans here, 425 loans. And that's 166.6 million pounds, and 250 have been repaid. 89.7 million pounds total repaid Lonepad loans since inception. So these numbers are very steady. It's been going on for a few years now. So we're seeing that really good history from Lonepad, and it's just good to see some stability in companies now. And I think you're gonna see that with the companies that are around right now. Not all of them, of course. There's always going to be bumps in the road, but for the most part, the ones that we talk about, I think hopefully you'll see that stability going forward now because of the more stringent FCA regulations that is happening in the sector and the industry. And stability is a nice thing. So let's take a look at some of the pieces of news. Not a lot this week, but we see Lonepad is going to be raising investor rates again. From April 1st, classic account holders will be getting a small bump up to 4.2%. That's what would be considered your available access account if liquidity does exist, what it always has as far as I've been watching Lonepad. And then premium account holders, which is the one that I tend to go for, is the 60-day access, 5.2%. And then it's going to raise up again on May 1st, 4.4%, and 5.4% for the premium account. So while we do see interest rates start to go up, of course, we had a Bank of England interest rate hike today of another 0.25%. We'll talk about that a little bit later. But Lonepad is trying to follow that trend and bump those rates up because, obviously as the bank's rates start to go up, they have to remain competitive. We're also seeing the platform's ISA rates going up in line with standard accounts. In May, the ISA rates will exceed that of standard accounts, so 4.6% for the classic and 5.6% for the ISA premium account. So, if ISAs is something you want to look at, and of course we're in ISA season right now, you can definitely get a higher rate in an ISA account of that 5.6%. Yes, it's not going to beat inflation. Nothing is right now, unless you're just gambling. But it's pretty good for what Lonepad offers in that lower risk area sector of P2P lending. And they will continue also to monitor loans and monitor interest rates as these rates start to go up a little bit. Brick Owner has increased its minimum investment from £500 due to £1,000 due to changes in the regulatory environment. We see that FCA regulation tightening, of course, around companies, and Brick Owners decided to put that minimum of 500 to 1,000. Incidentally, if you want to check out Brick Owner, we did do a Q&A session with Fred Bristol from Brick Owner. God knows how long ago. It was quite a while ago, but if you search the Financial Thing YouTube channel, you will absolutely find that video. You can see me talking to Fred Bristol about Brick Owner and what they're doing there. Brick Owner told customers any investors who already have £500 invested and wish to increase their invested amount will have to increase their investment to at least another £500 on top. The decision is being largely led by changes to the regulatory environment. Furthermore, when we look at amounts invested by existing investors, a large portion of our investors already invest over £1,000. So they're just really looking at what's going on and have increased their rates as needed. Easy Money CEO, what is his name? I know his last name is Ferrando. I think it's Jason. Yeah, Jason Ferrando. He has called for the FCA to change risk warnings. And this is something that I've heard a couple of peer-to-peer lending company owners tell me, is that they feel, and we've heard this on the Q&A live stream when we do these interviews, that peer-to-peer lending is really getting grouped into these very, very high-risk sectors when the FCA talks about peer-to-peer lending, things like cryptocurrency, payday lending, and things like that. And a lot of peer-to-peer company heads are not really happy about that. So not surprised to see this story come out where Jason Ferrando wants to see peer-to-peer talked about separately as a different type of risk warning by the FCA. Jason says, I wholeheartedly support ensuring investor risk is mitigated and that all such transactions are entered into an eyes wide open way. But for the sake of fairness and clarity, I feel a warning stating investors could lose all of their money would mean property values would have to drop to zero and stay at zero value for some time. It's an unfair approach to public disclaimers and to bundling payday lenders and unsecured loan shops together with other businesses that are fund secured against property he thinks is not fair. Now, personally, I think that we have seen some cases where peer-to-peer lending companies, people potentially would lose all of their money. So we've got the collateral case coming up soon, which obviously there's been some fraud involved. The other companies, more so that you're seeing return of money of certain low percentages, maybe say for Lendy, I would imagine something like 15% back if you're lucky. So I do agree with what Jason's saying about it's really unfair to say that they're going to lose all of their money, but there are, well, having to go back and also say that Collateral was really an unregulated, not an FCA regulated company. So anything that has been FCA regulated has everybody who has invested lost completely 100% of their money. That remains to be seen. Unlikely. So I do kind of agree with Jason, but it's a difficult statement because if people were to lose 95% of their money, then how do you make a risk statement that really covers all of peer-to-peer lending and the possibilities? Now, do I think that in the future companies that maybe go out of business would result in absolutely 100% losses to investors? I don't think that's going to be the case anymore, but I do think it's a difficult task to have an investment statement and a risk statement that really encompasses all of the possibilities that an investor could face when investing in peer-to-peer lending. So I think he's going to have a difficult time getting that one through. Jason also says, for instance, a company that raises capital as an unsecured payday loan operator is seen as the same risk as a company that invites investment secured by a first charge on property. Clearly, the two risks are entirely different. 100% agree with him in that respect. I think that peer-to-peer lending compared to some other risk profiles is in a completely different range, and that maybe has to be differentiated somehow. How the FCA does that, I really don't know. Let's take a look at the Assets Capital quarterly bulletin that came out. I'm sure this is probably something that all of you who are invested in Assets Capital has read. I'm just going to go through it real quick and point out some things that I think are important. Assets Capital wanted to clarify a common point raised by investors about why they made the decision to close retail investing in Assets Capital. Basically, what they're saying was placed and based upon the clear data that there was no longer any net interest in investing in new loans from our retail base. What that means was that there was no new money flowing onto the platform, and that along with withdrawals, this meant there was no new funding whatsoever available for new loan investment by retail investors. So when they say net interest, that means basically there has to be more money coming in from investors than is being withdrawn. And what they were seeing was a net negative event going on where more people were pulling money out than were putting in. And, this is really a lot to do with probably what was going on the platform. People were looking at their loan books going, I see a lot of loans that are not performing very well. And the confidence was starting to wane. I talked about this in my own loan portfolio in the manual lending account and shown it to you a few times where I could see a lot of the loans were having some problems, and it certainly made me nervous. And then, of course, this happens. And then we get this update. This followed continued bank interest rate raises that had led retail investors to withdraw capital on a net weekly basis, on the basis that demand and the substantial income stream it created had stopped. We had to reluctantly agree that our work was done in delivering new investments for retail investors over the very extended period of low interest rates prior to that. We repeatedly confirmed that we would also always give retail investors as much new investment as they wanted, subject to our ability to originate those investments. The ceasing of new investment demand from retail investors was a clear statement that our retail investors, on balance, no longer wanted our investment product at a viable level, and so the platform needed to close. Well, I think a lot of people who are investors and lending money through Assets Capital are just going to come back and say, look, if you'd provided a product that was doing what it was supposed to do, which is having a large amount of performing loans, I don't think customers would have started withdrawing all their money. So that would be the argument that I would tell Stuart Law right now. So there are some changes on the platform, most notably one we'll talk about in a minute that people are going to be pissed off about, which is a fee. Now the loan portfolio update. Since the platform was closed to new investments on the 15th of December 2022, 11 loans with a value of $6.5 million have been repaid, and with plot sales and other repayments, redemptions through the end of February 2023 totals $8.6 million. Loan redemptions arriving in the access accounts, which probably most of you are in, will continue for the time being to be reinvested into the remaining ongoing development facilities to meet future funding commitments, and that enabling these developments to be completed. We have no reason to change the view previously expressed, and we still expect access account investors will be able to start withdrawing capital in what's now approximately 3 months once we assure those developments are fully funded. So basically, money that is being repaid into the access accounts is being taken to fund ongoing development facilities. Now, I think that that's a bit of a gray area for me, because I'm thinking, well, I would like to be able to get money out of the access account, but instead you're taking my money and continuing to relend it. I think there's going to be some backlash to that. But I also understand that Assets needs to be able to continue to fund those development facilities that they've committed to doing. However, my question is, why not go use institutional money to fund that going forward? Why are you continuing to use retail money when obviously the retail investors want to withdraw? Also talks about conditions for some of the trading borrowers remaining difficult. Given the ongoing market uncertainty, we still expect to see a degree of increase in forbearance requests and defaults. No, that's not great. Now, if you look at this chart right here, you're going to see in the development loans, they have 26 total, and then default and recovery is 15. That's not a good ratio, right? Other loans, 159 with 50 in default and recovery. So basically you're saying 30% of your loans are not performing. Now here, if you add the total up, you've got 185 loans with 65 in default and not performing. So obviously Assets Capital has a problem that they have loaned to businesses that are really struggling at the moment for various reasons. And that's why we're seeing what's happening. Now here we go here, probably the most annoying news. They've decided to put together another lending fee to help shore up their income that they've been losing. And we are, as investors, going to have to take the brunt of that in the rear end. So through to the end of June 2023, 2.9% per year fee of performing loans. July to December 2023, 1.4%. They're going to be their fee. January 2024 onward, 0.9%. And this equates to an average fee level of 2.15% for the first 12 months and a 5-year effective fee of 1.15%. These fees are estimated and are subject to review over time, but have not changed since the last update. So not really good news coming out of the Assets Capital stable. I used to think Assets Capital was a good company. I think definitely made some mistakes with my investing regime through them and my plan, looking at things and showing how many manual loans were in just not performing well. And looking back, Assets Capital probably shouldn't have been on the Financial Think Top 5 list. It was low. It was bridging on number 5, but we'll see what the results of money coming back in over that loan book wind down are. But again, we never really know what's happening with these companies over the long run. We just have to do our due diligence and take the best guess that we can. There's also a word in here that I had to look up because I didn't know. Let me see if I can find it in here. I wonder if you know what word I'm going to talk about. Well, the word was de minimis. De minimis. De minimis. Yeah, I had no idea what that meant, and I wondered, why are you using such words, Latin words, which most people are not going to know unless I'm just really not an intelligent person. But basically, de minimis means too trivial or minor to merit consideration. So in the form of what we're talking about here, talking about very small balances in your access account that in the future you will be able to withdraw. Where is de minimis? Let me see if I can find it. Where is it? I know it's in here somewhere. I'm not going to be able to find it now. Anyway, moving on. Shojin. They did a study of 777 adults in the UK and found that 45% of UK investors don't understand tax due on investments. Also, half of retail investors in the UK do not have a good understanding of the taxes they must pay on their investment. The property investment platform Shojin found that 45% are not aware of tax they must pay, while 40% believe their investment strategy is tax efficient. This was for people with portfolios over £20,000. A lot of people don't understand their tax situation. I get this question asked a lot, and I'm certainly no accountant, but you need to know about things like capital gains tax. If you obviously use an ISA or IFISA, you're not going to pay any tax, which is the best case scenario you can be in. But there is a lot of misinformation about taxes and how much you have to pay. So definitely talk to an accountant. Peer-to-peer lending is not particularly well known. Some accountants don't really understand how the taxation works on it. So if you are going to speak to a professional, make sure they understand about peer-to-peer lending or point them to the right direction. But yes, you do have to pay taxes on any gains that you make, things like interest payments, gains on loans and things like that. You got to pay the HMRC. Otherwise, they're going to come and put shackles on you and take you off to the pokey. So make sure you check up on that. There we go. Look at Rishi from LendWise. What a great photo. Rishi, of course, been on the stream. If you haven't checked out the live stream, you can go to the Financial Thing YouTube page, and then up here, for anybody that doesn't know this, on the right, you can open up this little magnifying glass and search for LendWise or any of the other Q&A sessions that you might want to find. We also have a playlist here that says interviews and Q&A sessions that is all organized for you. But Rishi Zaveri has been on the stream 11 months ago from LendWise. But they are seeing that their loan book is increasing. Now it's above £30 million. They are an education-focused company. So basically they lend money to people that want to further their education, like graduate degrees. And their IFISA is now, let's see, is it the IFISA is over 30 or total 30 million. But you need to invest a minimum of £1,000. I actually really like what Lemwise is doing. Again, I do not invest through them, but if you were in their IFISA portfolio spread across all 41 IFISA providers, you would have received an average interest for the year of 8.83%. So pretty decent returns from Lemwise. So go check it out. You do need to put that IFISA money in before the end of the tax year, which is fast approaching. We're almost in April now. So I think you have until April 5th. So not long left if you want to get your ISA money put away somewhere. Also, Capital Rise is seeing an IFISA uptick after assets capital withdrawal. If you are interested in looking at Capital Rise, they do have an IFISA. They seem to be performing pretty well. Go check out Uma Raja. Her Q&A session is on the Financial Thing YouTube channel. If you haven't seen it, just go right here, type in Capital Rise. See if it pops up right here, the Q&A. This was 3 years ago when I did this in person with her in London. So go check it out. It gives you a good background on Capital Rise and the things that they do. Let's look at the LendInvest February 23 platform update. Let's see, 6 new investments, 6.6% per annum return, average loan to value 68%, average investment amount $370K. So LendInvest just continues to still put out new loans for the month of February. The 78% on schedule, 3% in arrears, 13% out of term, and 6% in enforcement. Again, like to see these numbers. I would feel better if this number right here was 85 or 90%, but it seems like LendInvest has a pretty good way of how they attack these out of terms and loans that are in arrears to stop them going into enforcement. They'd really try not to get down into this red area, so that process is pretty funny. We have to talk about banking because of what's going on, and I came across this funny video that I had to show you because it was I don't know if you ever seen the TV show South Park, but they're very politically and on the ball when it comes to political things that are going on. So this was just a great video. I thought I would just play it for you quickly. It's just a couple of minutes. You make sure I have the sound turned on here. Okay, let's go ahead and just watch this real quick.
How can I help you, young man?
I got a $100 check from my grandma.
Oh, hold on. That's coming out the wrong speakers. Let's try this again. I don't know if this is going to work, but hang on. Hopefully I didn't just... you know what? Hang on. Is that not working? It's not working. Anyway, it's basically, it's a funny... technical issues, of course. It's a video that basically one of the South Park kids goes in. He said, I've got $100 that I want to put in the bank because my dad told me it will grow and I want to invest it. So he gives the $100 to the bank. And then the banker goes, okay, I'll put your money in. And then a couple of seconds later, he goes, and it's gone. And the poor kid's just sitting there. You can see his face. I know you can't hear the audio, but you can see his face just looking really worried. And the guy goes, yep, your money's gone. He goes, well, how could it be gone? He goes, well, we're the bank and it just didn't perform. And that's what happened to your money. It didn't perform. So funny with everything that's been going on in the banking sector now, that video popped up. Next time I'm going to try to figure out how I can play that to you. I don't want to mess up the stream audio by messing with the audio settings. It was really funny. Little snippet. It was very, very pertinent for everything that's going on right now. Okay, let's talk about inflation. Well, would you look at this? The inflation numbers came out just a couple of days ago. And we can see that the CPI, the Consumer Price Index in the UK, has risen from 10.1% that it was in January year-on-year to January to February year-on-year to 10.4%. Oh my God, would you imagine? Look at that. These interest rate hikes are not helping. They're not helping curb this inflationary issue. Happening more in the US, that the inflation rates have come down somewhat, but I think we could actually see those spike back up again. And the UK is really suffering from a inflation issue that seems to be absolutely going in the wrong direction. I was not surprised. I was a little actually, I'll take that back. I was a little bit surprised. I was not expecting for it to go higher than it has been. I thought maybe it would stay sort of around that 10%, high nines. But you can see here the inflation rate has really, really increased to unprecedented levels. Like if you look at this line right here, which is the CPA 12-month rate right here, you'll see these numbers, 6.2, then rising up to 10.1 in July of 2022, backing off a little bit, going all the way up to 11.1 and coming back down to 10.1, and then back up to 10.4%. This is really, really bad news. And this really does go to show the problems that are happening in the economy, and specifically the types of strains that are going to be put on working class people. Definitely a squeeze on the middle class as things start to get more expensive. Things like petrol, gas, oil, restaurant food, cafe food has gone up a lot. Clothing, it's not really looking good. And then we saw today, Thursday, this came obviously with a Bank of England interest rate hike of 0.25%. Now this is the benchmark borrowing cost now, 4.25%. This is really going to put a squeeze again on people who have things like adjustable rate mortgages. These types of rate hikes just really hammer the consumer in bad ways, and I think this is just going to get worse as time goes on, unfortunately. In the US, we see some very interesting things happening because of what's going on with the bank system right here. There was an increase in the Federal Reserve's balance sheet. Let me refresh this because I want you to see what has happened here. See if I can zoom in a little bit. Come on. These charts, they don't always play nice. You see right here, this is very, very important to know. And it's not really been talked about a lot, but this was the US Federal Reserve balance sheet when it was just close to about 9 trillion. And you could see down here, this was when the QE was stopped, and then the bond buying was tapered. Yeah. And then all of a sudden, when this banking problem happens, now the Fed has to bail out the banks again. And now they've added another $300 billion to their balance sheet, basically wiping out all of the work that they've been doing over the last few months trying to get this balance sheet under control. It's not good in many different ways. It's not good because banks are really not your friend. Banks are not the consumer's friend. Back in 2008, during the meltdown, definitely caused by mortgage-backed securities, but the government came and bailed out the banks. And the really sad thing was that banks were supposed to use that bailout money to provide liquidity to the market, to lend to people. And what banks ended up doing, at least in the US, is they just used that money to buy more bonds and to basically put more money into their pockets. They didn't use that money the way it was supposed to be used. It was more of a for profit, greed. And again, what we're seeing now is another problem with the banking system. We've seen it with Credit Suisse, seeing it with a couple of banks in the US, and there's more banks that I think will have problems in the upcoming weeks and months. But banks are definitely not your friend, and you need to be careful as a consumer because number one, there could be a credit crunch to where your money could literally get frozen if a bank were to run into trouble. So in the US, of course, you have some protections over bank balances up to $250,000 in an account, and in the UK, $85,000 under FSCS protection. But just be aware that if something were to happen to a bank where you had all your money and it were to get frozen for some reason, you might not be able to have access to your funds until the FSCS were to come in and rescue that bank, which could be a problem for some people if they don't have things like cash on hand. So I always tell people, keep some cash on hand because the banks are definitely not to be trusted. We see this Credit Suisse article came out that said Credit Suisse say $17 billion of debt is worthless. So basically when it was sold to UBS, Credit Suisse, they wiped out $17.24 billion of debt that were basically called AT1 bonds. Those are junior position bonds that are generally bought by institutions. They get paid a higher yield. Buyer beware when it comes to second, junior positions on debt. We talk about this in peer-to-peer lending too. This is now showing its ugly head in the world of big finance, bank finance, where greedy institutions have come in and bought this junior debt, and they're going to find that their money's gone. And they were paid, I believe, around 10% on these bank bonds, and people automatically think, right? They think, bank bonds are safe. What a better place than putting money into a bank bond? Well, junior bank bonds are not safe, and now $17 billion has been completely wiped off, angering, of course, institutions that invested into these bonds. Now they're talking about lawsuits are going to start flying around because, of course, these institutions who bought up all this debt want to get their money back, and now they're saying, why should we suffer? And yeah, it's not good. It's not a good situation. So if you are thinking about doing like second junior lending on anything, just be aware that these types of things can happen. We now see it in the banking industry. It happens in peer-to-peer lending. You are going to take on a much higher amount of risk to get paid that extra yield. Institutions were willing to take on that much more risk for an extra few percent in yield. And they obviously didn't read the fine print, because apparently inside Credit Suisse, little terms and conditions on these bonds, it says that anything happens to the bank, you would be behind shareholders when it comes to priority on getting paid back. And apparently a lot of these companies didn't read that that was actually inside the prospectus. You can see here, CNBC reported that they actually read this fine print in there. And where is it? I just had it. The Credit Suisse prospectus seen by CNBC suggests that shareholders may be prioritized over bondholders, but specifically if the bank fails, right? So imagine being a bondholder and then being told, you're out of luck because now everything has failed. So what I'm getting asked a lot right now is, number one, are banks safe? I generally think they are. I think that because of the FSCS protection in the UK, of course, if you have more than £85,000 in your bank account, be aware that if the bank runs into trouble, you're not going to be protected over the $85,000. So make sure you don't have more than £85,000 in your bank account, which shouldn't anyways. I mean, nobody should be holding that amount of cash. It's not generally a good idea. But if you, for instance, you have a business bank account that has way more than 85 grand in it, you could start thinking about that what happens if one of these other, it could be a major bank, I'm not saying it would happen, but something like Credit Suisse goes down. Could a Barclays go down? Could Lloyd's go down? Yeah, absolute possibility. So pay attention to how much money you have actually sitting in bank account. In the US, if you have more than 250K in any single account, be aware that anything over $250,000 is at risk. So one question too I'm getting is, where is the money going now that there are all these problems in the market, right? Stock market is jittery. Where are people putting money? And we'll take a look at the Trading 212 account, which has actually been getting pretty hammered hard. I did liquidate to some cash, probably mistimed it to some degree because the next day after I sold some of the positions, I think I sold 30%. Of course, the market goes back up again. Classic example of emotional mistiming on my part. I talk about this all the time, why you shouldn't be dealing in the individual stocks. Just stick to index trackers, save yourself the hassle, because I'm going to show you, what it's cost me personally on this account. But where is the money going? This is what people are saying. Should I be investing in gold? Should I be investing in Bitcoin? Well, gold has definitely seen the price start to uptick because of all these problems. When people feel threatened in certain investments, they start to look at gold. Gold has always been sort of the safe haven run into. Seeing the gold price pretty high right now, over $2,003 it hit right now, just a hair under 1,997 US dollars for an ounce of gold. But if you look at the 20-year pricing chart on gold, it's really not perform very well unless you happen to be lucky and get in at the very right time. If you happen to be in this area, which a lot of people tend to buy in at these higher periods, because that's human emotion, right? When things are going well with an asset class, they go in, and that's them mistiming and going in at the wrong time. And when things are not going well, they tend to sell. So only the really savvy people would have been able to time it while coming in at 10 grand. But a lot of people that I know were coming in at these 15, 1600 price points, 1800 price points back in 2012. So over a 10-year, 11-year period, you just haven't really done well. So what could an investment in gold really be used for at the moment? I think it's really going to be used for stability. So if the markets, the equity markets, were to trace backwards at 20 or 30%, that's when you're going to see the gold market either hold its price, I believe, or rally as people come out of stocks and sell their stocks, move into safer things like and I would say perceived safer things, because I don't think gold is a particularly good investment, but they're going to run into gold, and that might be what sets this price starting to go up. And you could see even over the last month, if we look at the last month, when we started to see the banking issues, you see down here, this is exactly what happened. Money started to pour into gold because people get nervous and they think gold is some kind of a safe haven when they're worried about other things going on in the economy. Also, to note, looky here, the old Bitcoin, which, again, I hear a lot of backlash on Bitcoin saying, it's not a real asset class, blah, blah, blah. Well, there are a lot of people that believe, Bitcoin is a better place to have money than, say, your fiat currency like pounds and US dollars, because of the inflation eating away at that currency. So we've seen, again, a rally in the Bitcoin price over the last 7 days from 24,900, so almost 25. It did hit 29,000 at one point, so it's been kind of holding around this 27 to 28,000 US dollar amount. As you can see here, again, when all the banking problems started to happen, you start to see right here the money flowing into Bitcoin. So again, that's what people are doing when they get nervous and scared. Your average investor is looking, where can I move my scared money into a place where I think it's going to be safer and do well? Of course, Bitcoin has been one of those places where the money has has flowed into. And I'm personally, again, do your own research, whatever you may think about cryptocurrency. I would definitely rather have my money in cryptocurrency and Bitcoin specifically than sitting in a fiat currency getting absolutely eroded by a 10.4% inflation rate. Imagine you put in £10,000 into your bank account and a year later you're at 10% inflation. Now your money is worth $9,000. Well, that's like losing 10% in an investment. It's bad news, and it's not a good place to sit and have your cash. I love this rainbow chart. If you've never seen this is such a good. It's on blockchaincenter.net, and this really shows the historical price movement. Let me refresh this. The historical price movement of Bitcoin, and what it basically says, anything in the red area is maximum bubble territory, light red sell, and then we have FOMO, is this a bubble, down to green, still cheap, dark green, accumulate, and then basically a fire sale down here at the bottom. And you can see how accurate this has kind of been over the years of Bitcoin, going all the way back to 2011. So as long as Bitcoin has been around, this chart has really accurately shown when these areas are happening, just with this little rainbow coloring. And you can see right here, this is where we saw the big monumental run up, and then up into the mid 50s, and then the retracement back down. So you can see this is absolutely accurate when it comes to when you should be buying and selling if you're interested in getting into Bitcoin. You can see right now we're down in this this buy level. Before we were down basically in a fire sale when we were down at 16,000, which is the savvy people were going in at that point. Everybody else was scared, but the savvy people said, sorry, let me zoom in just a little bit here if I can. Sorry, that was down here. Yeah, back in, not quite zoomed in enough, but when it was 18, you could see that retracement up in the accumulation buy area down here, but down here also when the price of Bitcoin was just a little bit under 5,000 US dollars in that basically a fire sale stage. That's when people started to accumulate and get into this fear of missing out era, and then this big explosion, and then this huge pullback. I actually thought that we were going to get down into this blue area, but that did not happen. So we saw the territory get just down. It doesn't quite show you on the zooming in here, but the 18,000 time was, a lot of people again thought this thing was going to retrace down into the tens. It didn't. And now we've seen it go back up to 28,000. But yeah, if you see what this does. I don't know what that does. If you are interested in looking at the price tracing of Bitcoin as a potential place to at least put a little bit of your net worth, again, not all of it, but certainly a few percent if you're looking to diversify, this chart is absolutely fascinating. Go to blockchaincenter.net and look up the Bitcoin rainbow chart. Very, very accurate representation. Let's take a look at the trading 212. Let me just log in here, see where we are today. Trying desperately to get over that 15,000 pound mark, which we were a hair underneath it due to some of these poor performers like Deutsche Bank. Thank you, Deutsche Bank. Right now, seeing it 14,732 pounds. So this account has lost about 5,000 pounds. Right now, we're sitting at 9,272 invested, 5,460 in cash. I decided to sell off some of the things I wasn't feeling too comfortable about, taking a bit of a tax loss on them for harvest reasons. And you can see things have just not really been going very well in the portfolio, hence the move to cash. Why will this not go down? Are you frozen? Come on, there we go. The only thing in the green at the moment is this FlexLink natural gas. Everything else is just absolutely not doing well. Zim doing pretty good right now. Only 3% in the red, which is pretty good when you compare it to Calera, which is almost down by 50%. And then this Ginkgo Bioworks. But, you know, I always want to be transparent and show you the wins and the losses. And this one it's not been a very good session or year so far as this portfolio goes. Personally, I think the whole stock market is just going to be a bit of a mess for a while. So I'm going to hang in with the rest of it for now, unless I read some really detrimental things that would make me want to change this portfolio around. This is what I'm sticking with. We do have a pretty big Zim integrated shipping dividend payout coming up soon. So we got 73 shares, which is going to result in a dividend payment of $467 US. I mean, what happens when that dividend gets paid out is this price is really probably going to drop a lot, but I don't really see any sense in selling it. I'm going to collect that really big dividend, see what happens to the stock price in the next 3 to 4 months, and then make some decisions there. But yeah, not looking too great. You know, will it go to zero? Who knows? Stay tuned. I don't think so, but we'll see. We have a huge stock market retracement down. You know, who knows? We have pulled some profit on this portfolio over the couple of 3 years that we've had it. So, you know, there are some bright spots, but right now, this really shows the potential problems trying to pick your own stocks out, for sure. Maybe some people have better luck than I do, but this is why I love index trackers. I don't have to worry about these types of 54% losses. And also, I'm not going to get the 32% wins, but as you can see right now, we've got one winner and the rest of them losers. That's not a good spot to be. So stick to the index trackers. Everybody who is inexperienced, or even I would say advanced investors, of course, do your own research, but take this type of emotional decision making out of the picture. You can buy one or two index trackers and never have to worry about this type of disaster happening to your stock account. Oh, but I don't want you to feel sorry for me. It's just, it is what it is. You know, it is what it is. Things happen. Follow the rainbow pot of gold. Yeah, I'll see if you have any interesting comments. We're just a little bit under an hour. Yeah, don't forget, is it next week we have planned, I believe? Come back. Yeah, next Thursday we'll be here with Rob from Planned. It'll be a good chat. I want to find out when we're going to be allowed to invest in that as a peer-to-peer lender. Hi, Jackie from Essex. Nice to see you. Yes, good answer, Annabelle. Oh, it was. Sorry about that. It was working. The sound was working. I don't know. It didn't look like it was working. Let me see if I can play it for you then if it was working. Hold on. Let's see. Let me check it. Hold on. You want to see the South Park? Hang on a second. It doesn't... Is it working? It doesn't look like it's working. Is that working? I don't think it's working. Technical issues. I'll get it sorted next week. I'll play it to you again. It's funny though. I like that comment, Alan. The rainbow chart is an accurate reflection of what happened in the past. It's absolute nonsense to suggest it can be used to predict the future. There's nothing to stop the price crashing lower. Absolutely. What a great point. I love it. You cannot predict the future with a chart. But you can look at the history and say, this is what we think might happen. It's been accurate somewhat for 10 years. But yeah, absolutely agree with you. There's no guarantee. None. That's a very good comment. Maybe I really want to make this South Park video work for you. Now, let me give it one more last try. See if it works.
It's God.
What do you
Is that
mean?
working?
I have $100.
There we go.
Not anymore, you don't. Poof.
It's working now. Now, I'm going to replay it for you. Let me plug in my headphones so I can hear. This is a very funny video. It's just a couple of minutes. You refresh it. So there you go. I just thought that was so funny because that was the way I felt when I invested my money with a financial advisor back in the early 2000s. my account just didn't do very well, and I was down much lower in balance than when I started years ago. It's gone. So when I saw that video, I thought, oh, it's so funny with what's going on in the banking industry right now. Very, very funny. So yeah. Oh, anyway. I think we're going to get out of here. It's been over now. Come back next Thursday. Come hang out with me and Rob from Plend. We're going to have a nice chat. Holly will be here too. Hope you guys have a great weekend. Enjoy it. Enjoy that nice British weather. Love all of you. Thanks for being here. Appreciate it. And I'll see you next time. Take care.